Hey friend, welcome back to the channel. This is Jeremy. I'm designer and co-founder of Yieldr, which is a stock research and dividend tracking tool. And today I want to teach you how to invest like Buffett. Now, first of all, I just got back from the beach and I'd love to tell you that I spent the whole week just relaxing in the sun, but instead I spent most of my time chasing down my 4-year-old because he is like a magnet to the waves. I don't know what it is, but this big, gigantic thing that's going to topple over him, he just wants to run right into it. So I got some good exercise in and got to, run up and down the shore chasing a 4-year-old. But he did nap. And while he napped, my wife and I did get to go back and lay out on the beach. And while we were there, I spent time reading through Berkshire Hathaway shareholder letters. I know, very nerdy. My wife made fun of me. Yes, you can definitely count on that. But I found this letter from 1977 where Warren Buffett gives us a master class on investing. First of all, I'd like to point out, true to Warren Buffett's style, there is nothing flashy about this. You can find every letter on the website, but it doesn't even span full width. It's in a little tiny corner on the side, but it's great. But this is like years of wisdom. And more than 50 years ago, well, I guess I say almost 50 years ago, Warren Buffett gave us 4 criteria for finding great stocks. So today we're going to take that wisdom that is probably more relevant today than it was 50 years ago, and we're going to apply it to our 12 stock dividend portfolio that we're building here inside of Yieldr. Now, we're building this from scratch. We just started a couple weeks ago, and today we're going to look at one of the key pieces that Warren Buffett lays out for us, so one of the 4, and we're going to apply that to our latest stock purchase. So every week we're investing money. This week we have $500 we're going to be investing. We've been doing equal weight, but we're going to listen to Uncle Buffett here, and we're going to change up our style. So we'll get to that in just a minute. For right now, let's go back and let's dive into this letter. So he says, we select our marketable equity securities, aka our stocks, in much the same way we would evaluate a business for acquisition. So first of all, this at the time was probably a brand new way of thinking about investing. It wasn't about tickers or sheets of paper, or as we know, companies we hear in the news. This is about owning a company, becoming a partner in a business. So much like I am a co-founder of Yieldr, when I choose stocks, I like to think of it like Buffett lays out right here, which is, this isn't just a marketable equity security. This is a business. He gives us a lens to view his 4 criteria through. All right, so number 1, he says, we want businesses to be one that we can understand. Now, this sounds so simple, but this is actually something that Peter Lynch, one of my favorite investors and authors of One Up on Wall Street, tells us in that book that this is our retail investor edge over hedge fund managers and the professionals. And that is that we can look around us and start investing in things that we know and things that we understand. Now, this doesn't mean you know every detail and the nitty gritty. It just means, in my opinion, something, you know the business, you know what they do and how they make money. So if Warren Buffett and Peter Lynch are aligned, I think we can accept that number 1's pretty solid. Look for a business that we can understand. Number 2 is look for a business with favorable long-term prospects. So we want something that we're confident is going to grow over time, because we want to hold these companies long-term so we can get that compound interest and get that dividend growth. And you only do that by holding companies year after year. So I like this because this goes back to another topic that Warren Buffett's famous on, that's on moats. So when we look at these companies, we're looking for a competitive advantage. All right, number 3. Now this one's a little harder for us retail investors in that we want a business to be operated by honest and competent people. So obviously we don't get the luxury to sit down and talk to business owners and tell if they're honest, tell if they're competent. So we have to kind of use context clues. So the first thing we can do, if we just pull up a company like Zoetis, which is one of our 12, there's some metrics that help us know how competent the business is. And one is ROIC, return on invested capital. So this measures how efficiently a company generates returns from the money it invests, right? So the money it puts into its products, into its services, what is the return? And you can see for Zoetis, it has been growing over years. So that is the best thing, this trend that's up and to the right. And the last few years where it's leveled out, it's been over 20. And if we jump back in here, we can see that an ROIC above 20 is considered excellent. So this is a first sign for us and some context that we can use to know that Zoetis in particular, does have competent management. Now, when it looks at honesty, that's a little hard, right? Like with my partners at Yieldr, I can talk to them, I can get to know them, I can learn over time by their actions. A little harder with a big corporation, us on the other side of the screen. But one thing I like to do is listening to earning calls. And I like to try to find out, do these CFOs, CEOs, do they own their mistakes or do they cover them up? And if they own them, do they explain, do they tell us how they're going to fix it? And these are things that to me help me know that they're honest. Sometimes you can just tell by their tone. Are they defensive? Are they relaxed? Are they optimistic? These are things that I look for. I also want some humility. I want them to be real people, and I don't want them to be a robot. I want them to have personality and to be authentic. So I find that mainly from listening to the earning calls. The other thing we can do is look at compensation packages. So how is leadership? How do they get their bonuses? How's that structured? Does it align with us as the shareholder? All right, so that's operating with an honest and competent people. All right, so number 4. This is the one that I think retail investors get wrong, and that is we want a business that's available at a very attractive price. And we hear a lot about DCA, which is dollar cost averaging. And for ETFs and funds, this can be great because you're just going to continue to put your money into those ETFs because it's a basket of stocks. So you're not as worried about valuation. But when we hold a concentrated portfolio like Yieldr 12, which is 12 stocks, maybe we want to start looking at this with a little bit more precision than just equal weight investing, which is what we have been doing up to this point. And I think you can see the importance here because this is the only one that Warren Buffett elaborates on. So he spends this next part of the paragraph by saying, we ordinarily make no attempt to buy equities for anticipated favorable stock price behavior in the short term. In fact, if the business experience continues to satisfy us, we welcome lower market prices of stocks we own as an opportunity to acquire even more of a good thing at a better price. So he leans into this valuation method, and I think this requires us with a 12 stock portfolio having patience because there could go some weeks, some months where some of these companies don't get as much love. And we have to just have faith and understand, trust Warren Buffett's process that over time our patience will pay off. So if one company isn't valued attractively right now, we can wait knowing that over the course of the next several years, we're going to be able to continue to invest in all of these. Those are the 4 things. A business that we can understand with favorable long-term prospects, operated by honest and competent people, and available at very attractive prices. So we're going to use Yieldr here, and we're going to apply that number 4. Instead of just doing the equal weight investing for 500 this week, we are going to look at which companies are undervalued, which companies are fairly valued, and which are overvalued, and we're going to allocate our 500 accordingly. So it says valuation tiers. Tier 1 is undervalued, which we're going to allocate more money to. Fairly valued is 2, and that's lower money. And then if it's 3, if it's overvalued, we're not going to invest any of our 500 this week into that company. So let's go through, use Yieldr Valuation Tool to help us determine when a stock is trading at a discount or premium. So let's look at Accenture, which we know has been under attack by the threat of AI. And if you believe that can benefit from AI versus being disrupted, then this looks really good because we see it as at a 63% discount. Now, to catch you up on our valuation tool, we take 3 popular methods where we look at price to earning, free cash flow, and dividend yield theory. And we take the current versus the 5-year rolling, and we kind of compare those to see where a discount. This is not the be-all valuation, but it is a good method to use to compare the current with the 5-year, knowing that over time the price usually follows the fundamentals. So we can look at this for Accenture, and we can see that we have a pretty steep discount for all 3 of these metrics, and it gives us a 61% discount. So we can put Accenture as one of our tier 1 undervalued stocks. So we'll go ahead and put Accenture in there. All right, next up is Snap-on. So when we go to Snap-on, we can see it has a 27% average fair price premium. And when we look, we can see all three metrics apply a premium to it. Now, Snap-on does usually trade a premium. If we look back, we can see, we have to go back to 24 to see it trading in undervalued and fair valued territory. And it did that for quite a while, and then it jumped up. So, we're overpriced. So we could be a little lenient on this one, but for the sake of now and sticking to our rules, we are going to put Snap-on in the tier 3 overvalued category. Because we have to remember, right? Warren Buffett said a very attractive price. So we want to make sure we're spending our money wisely. Now we look at Rollins here, we can see they are at a 25% discount. And again, all three valuation methods are showing us a pretty steep discount. So pretty confident we can come back to our prompt here and put Rollins as a tier 1. All right, so let's go down. Let's look at Main. Now, Main Street Capital is a business development company, a BDC. Now, this is a little harder to apply, these traditional metrics to. PE, free cash flow, doesn't apply as much. So we can look at dividend yield theory, and we can see it's giving it 11% premium. So this one's an interesting one for me, because if you go back and look at the 5-year or the 1-year range, you can see it's, closer to the low than it is the high, but it's still showing a premium. And even when we zeroed in on dividend yield, it was still a premium. So we are going to stick with that, and we're going to come in here and put Main as overpriced as well. All right, so let's keep going. Let's look at TJX. Now TJX is showing a 1% discount. And then you can see here, PE is down 9, free cash flow is up 20, and then dividend yield is 21. So since the average is showing us a 1%, we're going to agree with that, and we're going to put that in tier 2, which is fairly valued. So TJX will go right there in fairly valued. Next up, we're going to look at Visa. Visa showing a 0 premium. So once again, pretty confident here. We can put Visa also in the fairly valued category. All right. Good thing we only have 12 stocks, right? All right, Microsoft, 14% discount. Again, across the board. Free cash flow is the one that's teetering. It's pretty much a 0 discount right now. They're spending a lot of free cash flow, so I kind of expect that to be lower. So I think based off of this, we can, put Microsoft up here with our tier 1 stocks. Now, this doesn't mean, that this is 100% accurate. I mean, this is just a valuation method that we can use. So keep that in mind. This is a good point to say that I am just a guy on the internet, not your financial advisor, not even a financial advisor. So take all this as entertainment. I'm just sharing my journey. Never blindly follow me or anyone else on the internet without doing your own research. So there's that. All right, let's look at Zoetis. Zoetis is trading at a steep discount. Actually, all three valuation methods show us at least 60%. That gives me quite the confidence that this one belongs in tier 1. All right, then we get EOG. Now, oil companies with the war have been higher. They're starting to come down, but I'm not surprised to see a premium. EOG is one that's a little harder to use these conventional methods, but I think right now it's going to go in tier 3. All right, who we got next? Allstate. All right, Allstate, our average fair price is 8%. Now, this one's also a little tricky to just use conventional methods. As you can see here, the negative historical EPS, so we can look at the negative 129 like that, basically breaks the model and means that this is not as accurate as it could be. Since this one's a different beast, insurance usually is, we're going to put this one in fairly priced. Because none of the valuations, if I'm being honest, work well with Allstate. So you do have to know, understand what you own, know how to evaluate it. That one is tricky. All right, Torino Realty is 30% discount. This one, our best metric is going to be dividend yield theory, since it's a real estate company. it's not, super far off compared to where it's been throughout the last couple years, but it is still a 5% discount. So we are going to put TR and O in tier 1. I teeter a little bit, between tier 1 and tier 2. We're going to keep it here at tier 1 for now, I think. And then we have ADP. ADP is a significant discount. So you know what? When I see this, I see ADP. It reminds me of Warren Buffett's quote, which he says at a very attractive price. So I'm going to actually move TRN down here, and I'm going to put ADP in place up top. So this should be it. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. All right. So one thing that I love doing is opening up Yieldr inside of Chrome so I can use Gemini, and it can help us allocate our money here. So I'm going to put this in, help us allocate our 500 weekly investment between these 12 stocks based on the tiers below. All right, let's see what it gives us. So it's always fun. You can use Gemini to do some more deep, extensive research. It's awesome because you don't have to try to explain what you're looking at. It can read Yieldr and then give you the information. So here it says the query is unsuccessful, but then it says it has calculated an allocation plan. So let's see. It looks like that it did it. So it looks like these stocks are going to get $80. These stocks, tier 2 are going to get $25. And then tier 3 are going to get 0. Now, I'm sure I could go in and tweak this a little bit, but honestly don't mind it. I don't mind really focusing on the very attractively priced companies. So my next step here, I'm not going to bore you with it, is I would jump over into public, and I'm going to just go through, and one by one, I'm going to make, all these investments based off of the valuation and learning to invest like Buffett. So I hope you learned something, in this episode about using not only Yieldr, but just using Buffett's wisdom to build out a better portfolio. And if anything, to think through the lens that Buffett is giving us to evaluate these stocks as businesses that we become owners of. Now, I would love to hear from you. Are there any shareholder letters that stand out to you that maybe I could dive into here on the channel? This is 1977. What's your favorite? The other question I have for you is, are you applying these? Is there one that sticks out with you, one you disagree with? Let us know in the comments. I always love hearing from you guys. Until next time, happy investing.